VCs are usually very sensitive to high valuations, but at other times, the same investor will be flexible and willing to overpay to invest in some startups. Why is this? Hey, this is Vineet Bhansali. Here are some reasons why investors are sensitive to higher valuation. A higher valuation means the investor gets a smaller equity stake for the same amount of money. Number two, if the entry valuation is too high, it can be challenging to achieve desired exit multiples. Every VC has a target exit at the fund level, and this can affect their own targets. Number three, a high seed valuation can set high expectations for subsequent rounds, which can be problematic if the startup doesn't meet its aggressive growth targets. This might lead to a delayed next round or even a down round, that is, a next round at a lower valuation. Now, let's look at reasons investors may be okay with higher valuations. Number one, they believe strongly in the founding team's insights. Think of stellar founders, Kunal Shah, etc., who raised seed at high valuations. Number two, the investors might see massive potential in the market that the startup is targeting. Often, this is previously unavailable or unidentified market that suddenly opened up. Number three, there's a strong thesis match. Investors usually create a thesis in specific sectors, and when they find a startup that aligns closely to their thesis, they feel confident to be flexible with the valuation. Okay, now let's look at the next question. What are the pros and cons of funds having a hard upper limit on valuations? Here are some pros. It ensures that the fund maintains a disciplined investment approach. Number two, protection against overvaluation. Startups with inflated valuations can face difficulties in future rounds if they can't justify their worth. Number three, it ensures desired ownership percentage. A hard valuation cap can ensure that the fund maintains a specific ownership percentage in the startups it invests in. This is important to balance diversification and fund returns. What are some cons of having a hard valuation limit? Number one, missed opportunities. Setting a hard limit might mean missing out on promising startups that have slightly higher valuations. Number two, competitive disadvantage. There could be other more flexible investors who are willing to outbid on certain deals. While it's essential to avoid overpaying and to maintain discipline, it's equally crucial to be flexible enough to capture high potential opportunities when investing in startups. The reason this is so is as a seed stage VC, most misses are errors of omission and not errors of commission. Meaning, a winning startup the investor declined investing in hurts more than having invested in a winner at a slightly higher valuation. I hope this is helpful to both early stage founders as well as those looking to get into the VC space. I'll see you guys later. Bye.